Welcome to the Deep Dive, where we cut through the noise and get you the insights that matter.
Glad to be here.
Today, we're plunging into Rogers Communications' second quarter 2025 results. Management themselves called this period significant, and looking at it, they weren't wrong. Some major financial and strategic moves happening.
Yeah, definitely significant. A lot going on. Our job today is really to break down that performance, look at the strategy, and figure out what it all means for the market.
Exactly, distill it down for you. So let's start with the snapshot, the big picture results.
Okay, so Rogers delivered, I'd say, pretty solid operating numbers across the board. Wireless, cable, media, all performing.
Right. And the headline numbers. Consolidated service revenue and adjusted EBITDA both grew by 2% year over year.
That 2% sounds maybe modest, but given the headwinds, inflation, competition, even changing immigration numbers affecting subs, it's actually quite resilient growth. Shows that diversified model is working.
Good point. And for me, a real highlight was seeing the cable business return to revenue growth.
Yeah.
That segment had been declining, so turning it around is notable.
Oh, absolutely. A big turnaround story starting there. And on the financial side, huge progress on deleveraging. They hit their Shaw acquisition leverage target.
Yeah, and get this, about 9 months ahead of schedule, that's pretty impressive execution.
It really is. Speaks volumes about their focus on the balance sheet.
And hitting that target early, that gives them so much more financial flexibility, right? Frees up capital for, well, whatever comes next. Investment, returns, maybe more deals.
Precisely. And speaking of deals, the other massive thing this quarter, or technically closing just after, was becoming the majority owner of Maple Leaf Sports and Entertainment, MLSE.
Right, 75% controlling interest. That brings the Leafs, the Raptors, all under their umbrella. Closed early Q3, so we'll be watching the impact unfold.
Definitely one to track.
Okay, so that's the overview. Let's peel back the layers now and really dig into those pivotal financials.
Let's do it. So consolidated, as you said, 2% growth, service revenue, and adjusted EBITDA. Solid performance, especially considering the environment.
And that flowed through to strong free cash flow, too, and they maintained pretty healthy margins.
Yeah, very solid. Now, let's break down the segments. Wireless first.
Go for it.
Okay, wireless service revenue and adjusted EBITDA, both up 1%. The market growth itself, though, it moderated. Management pointed to reduced immigration levels as a key factor there.
So fewer newcomers needing lines, basically.
Exactly, which meant total wireless net adds were 61,000. That includes 35,000 postpaid. Now compare that to 162,000 last year, quite a drop, but it reflects that broader market shift.
Right, context is key there. But on the positive side for them, churn improved, down to 1%. That suggests they're holding on to customers well.
Good base management, yeah. But the flip side was blended mobile phone ARPU, average revenue per user. That was down 3% to $55.45.
Okay, why the drop there?
A couple of things. Intense price competition. Definitely. And also lower outbound roaming revenue. Seems fewer Canadians were traveling to the U.S. compared to maybe the post-pandemic surge.
Ah, okay. But wireless margins still edged up slightly.
Just a touch. Up 10 basis points year over year, landing just over 65%. So still very profitable.
Okay, let's shift to cable. This is where that turnaround story really plays out.
It really is. Service revenue up 1%. Now remember, it was down 4% year over year previously, so quite the swing.
That's significant. And EBITDA?
Even better. Adjusted EBITDA grew 3%. That was driven by that revenue growth flowing through efficiently. Plus, they cut operating costs by 3% through, finding efficiencies.
Nice. And internet additions, still strong.
Yep, retail internet ads stayed strong at 26,000, pretty much consistent with last year, shows continued demand.
And the margins in cable?
This was impressive. Cable margins jumped substantially 150 basis points, now sitting just over 58%. Getting that kind of margin expansion in cable is quite something.
Wow. Yeah. Okay. And then media seemed like a strong quarter there, too, at least on the top line.
Definitely on the top line. Yeah. Revenue up 10% to over $800 million. Big boosts from Sportsnet with the NHL playoffs. Higher Blue Jays revenue. Fans are engaged. Maybe the team's doing okay. And the launch of those Warner Brothers Discovery channels.
The content is king, right? But EBITDA is more modest.
Yeah, media EBITDA was up only $5 million year over year. That's because operating costs also jumped 9%, mostly driven by programming costs and, yes, those Blue Jays expenses like player salaries.
Right. Costs money to make money, especially in sports.
Exactly. And looking ahead with MLSE consolidating from July 1st, they're estimating full year 2025 media revenue pro forma at $3.9 billion. They've been around $250 million.
Big numbers. And they put a value on those sports and media assets.
They did. They estimate the value now exceeds $15 billion, and they made a point of saying they see unrecognized market value there. We'll come back to that.
Definitely. Okay, let's talk capital, liquidity, debt. What's the story there?
Some really interesting moves. Capital expenditures were actually down 17% to $831 million.
So spending less on infrastructure.
Relatively speaking, yes. It brought their consolidated capital intensity down 370 basis points to 16% for the quarter. Lower intensity is generally good, more efficient spending.
And that efficiency plus the solid operating results must have impacted free cash flow.
Oh, massively.
Yeah.
Free cash flow surged, up 39% year over year to $925 million. That's a huge jump. Really significant cash generation.
Wow. And their overall financial position? Liquidity.
Very strong. Liquidity stands at just under $12 billion. A big chunk of that is thanks to a $7 billion equity investment led by Blackstone.
Right. The Blackstone deal. How does that work?
Well, it provides a lot of cash up front. It does mean Rogers will have annual distributions of about $0.4 billion related to that investment. But crucially, it significantly offsets interest expenses. So it gives them a lot of firepower.
Got it. And leverage. We mentioned they hit the Shaw target early.
Yep. Leverage improved down to just over 3.5 times. Hit that target 9 months ahead of schedule. Huge win. However.
Uh-oh. There's always a however.
Well, the acquisition of that extra 37.5% of MLSE was funded mainly by bank debt and cash on hand. So that pushes the pro forma leverage back up to around 4 times.
Okay, so one step forward on Shaw deleveraging, but the MLSE deal adds leverage back. Kind of a reset.
Exactly. It shifts the near-term focus back to organic deleveraging again, post-MLSE.
All right, let's move into the strategy side. Management insights, new initiatives. This is often the most interesting part of the call.
Agreed. And they had some big ones. Network innovation first. Rogers launched satellite-to-mobile texting, a Canadian first, they highlighted.
Satellite texting, how does that work?
It lets you text even where there's no cell coverage. It's in a free beta trial now across huge areas. They plan to expand it to apps, data, even voice, including 911 service.
Okay, that sounds potentially game-changing for remote areas. Is it going to be expensive?
It'll be $15 a month starting in October, but only $10 for the beta users. They're partnering with Starlink and Telesat on it. Plus, they're rolling out 5G Advanced and Wi-Fi 7. So really pushing the network tech.
Very future-focused, but that kind of investment runs up against regulatory stuff, doesn't it?
It certainly can. And management had some strong words about the CRTC's recent decision. That's the regulator, for those less familiar.
What was the decision?
Allowing competitors to resell services on Rogers' network, even outside their traditional wireline footprint. Management argued this basically kills the incentive to invest in building out networks.
Strong words indeed.
Very. They warned it could force them to cut capital spending, potentially costing construction jobs, putting billions in investment at risk. They even called for the federal government to step in. That's pretty direct.
Yeah, you don't see that every day. It highlights a real tension there. Okay, what else on strategy? The sports and media assets?
Right. Remember that $15 billion plus valuation and unrecognized value? They said they're actively exploring options to monetize and surface that value. Thinking about synergies between the Blue Jays and MLSE too.
Monetize how? Selling parts off? Spinning something out?
They didn't give specifics, but they said expect updates in the midterm, which they clarified means sooner than 2027, but no firm date. Clearly a major focus though. They think the market isn't valuing these assets properly inside Rogers.
Interesting. What about the core wireless competition?
Management sees a shift. Less focus on just grabbing subscribers at any cost, more focus on, quote, getting pricing right.
So less chasing volume, more focus on value.
Seems like it. Rogers is simplifying plans, introducing new tiers, pushing multi-line discounts. The goal is to move customers up to higher tiers, boost that ARPU in the second half of the year.
And those multi-line discounts, are they profitable?
They see them as incremental revenue, targeting second, third, fourth lines on an account at around $30, $40, trying to capture more of the household spend.
Makes sense. Anything on fixed wireless, that 5G home internet product?
Yeah, they said it's performing really well, both inside their traditional cable areas and outside. They credited tech like network slicing, basically creating dedicated fast lanes on the 5G network and integrating with Comcast's Xfinity platform.
Okay. And one last bit, data centers. Are they expanding there?
Nope. Opposite, actually. They're looking to sell their data center business. Clear signal, they're focusing on the core, wireless, wireline, media, not expanding into that area.
Got it. So let's try and pull this all together for investors or anyone tracking this space. What's the context?
Well, I think this quarter really highlights Rogers' dual focus, doesn't it? On one hand, disciplined execution in the core telecom business, hitting targets, managing costs, turning cable around.
Right, steady operations.
But on the other hand, these big, bold, transformative moves in sports and media with MLSE.
And that early deleveraging after the Shaw deal, that's a massive positive signal about financial discipline.
Absolutely. But, as we discussed, the MLSE deal bumps leverage back up temporarily. So the narrative shifts a bit, right? Now it's about managing that new leverage down organically and, crucially, making good on that promise to monetize the sports assets. That becomes key.
And that CRTC ruling looms large as a potential headwind, a risk to future investment that investors definitely need to watch.
For sure. But then you balance that against the innovation satellite service, 5G advanced, Wi-Fi 7. That shows commitment to network leadership, which could be a differentiator.
So connecting the dots, it feels like the long-term value story here is increasingly tied to their ability to unlock that unrecognized value in sports and media. It's not just a telecom play anymore.
Exactly. It's becoming a much more complex story about connectivity and content and how you extract value from both.
Okay. Now for that part of the deep dive where we speculate wildly, but plausibly, our not financial advice segment.
Always fun. And remember, folks, seriously, not financial advice, purely an intellectual exercise.
Okay. So given Rogers' focus on paying down debt in the core business and their very explicit comments about monetizing sports and media, mentioning that $15 billion plus value, the unrecognized bit.
Where are you going with this?
You could theoretically structure a speculative spin-off arbitrage trade.
Ooh, okay. How would that work?
The idea would be go long Rogers stock, buy RCI shares. But simultaneously, you'd use derivatives, maybe options or something more complex, to bet on a future spinoff or sale of a big chunk of MLSE or Sportsnet happening at a premium valuation.
So your betting management actually pulls off this monetization.
Yeah.
And that the market values those assets higher on their own than inside Rogers.
Precisely. You're betting they can close that unrecognized value gap they keep talking about. It's super speculative, of course. The timing, who knows? The structure, uncertain. Could take years, might not happen exactly like that.
But it's plausible because management is actively signaling this is a major strategic priority. They've put that $15 billion number out there themselves.
Exactly. Makes it a fascinating, if high-risk thought experiment.
Definitely high risk. Okay, let's bring it home. To recap,
Rogers delivered a strong quarter overall. Consistent core performance, that impressive cable turnaround, hit the Shaw deleveraging goal way early.
And the MLSE integration is now complete, positioning them as this huge sports and media player with a clear focus on unlocking the value there.
Moving forward, though, all eyes are on how they handle that CRTC regulatory challenge and, maybe more importantly, how they actually execute this sports and media monetization strategy.
Absolutely. Those are the key things to watch.
So here's a final thought for you to chew on as we wrap up. In this era where basic connectivity is vital but maybe becoming more commoditized and unique content is incredibly valuable, how do companies like Rogers balance the huge costs of building next-gen networks against the strategic need to unlock value from these non-core but potentially very lucrative assets like sports teams?
Yeah, what does that tension mean for how they allocate capital? And maybe even for the future structure of these big telecom giants? It's a fundamental question.
Something to think about. That's all for this deep dive. Thanks for joining us.
Thanks, everyone.